The Bank of Canada has been raising its benchmark interest rate since March 2022 to fight inflation. Inflation is the increase in the prices of goods and services over time. It erodes the purchasing power of money and lowers the living standards of people. The latest rate hike was on June 7, 2023, when the bank raised its rate from 4.5% to 4.75%. This was the highest level since 2001 and the ninth increase in 15 months. The bank said it was concerned that inflation could get stuck above its 2% target for a long time. The rate hike affects the cost of borrowing and saving for Canadians. It makes mortgages, loans, credit cards, and other debt more expensive. It also increases the returns on savings accounts, bonds, and other investments. The rate hike also affects the inflation rate and the cost of living for essential goods and services, such as food, housing, transportation, and health care. These are some of the ways how. Higher interest rates make the Canadian dollar stronger against other currencies. This makes imports cheaper and exports more expensive. This can lower the inflation rate by reducing the cost of imported goods, such as food and clothing. But it can also hurt the competitiveness of Canadian exporters, such as manufacturers and farmers, and reduce their income. Higher interest rates reduce consumer spending and business investment. This can lower the inflation rate by reducing the demand for goods and services. But it can also slow down economic growth and employment. Higher interest rates increase the cost of housing. This can raise the inflation rate by increasing the cost of renting or owning a home. It can also make housing less affordable and accessible for many Canadians, especially those with low or moderate incomes. Higher interest rates increase the cost of transportation. This can raise the inflation rate by increasing the cost of fuel, public transit, car payments, and insurance. It can also make transportation less affordable and convenient for many Canadians, especially those who live in rural or remote areas. Higher interest rates increase the cost of health care. This can raise the inflation rate by increasing the cost of prescription drugs, dental care, eye care, and other medical services. It can also make health care less affordable and accessible for many Canadians, especially those who are uninsured or underinsured. The impact of higher interest rates on inflation and cost of living is not uniform across all Canadians. Some groups may be more affected than others, depending on their income, spending habits, debt levels, savings, assets, and location. One of these groups is minorities, who may already face social barriers such as discrimination, racism, sexism, homophobia, and xenophobia. Minorities include people who identify as Indigenous, Black, Asian, Hispanic, Middle Eastern, or other racialized groups, people who identify as women, LGBTQ2S+, or persons with disabilities, people who identify as immigrants, refugees, or newcomers, and people who identify as religious minorities. Minorities may be more vulnerable to higher interest rates because they may have lower incomes and higher poverty rates than non-minorities, less access to education, training, and employment opportunities than non-minorities, more difficulty accessing credit, banking, and financial services than non-minorities, more reliance on debt to cover their expenses than non-minorities, less savings and assets to cushion against financial shocks than non-minorities, more exposure to precarious work, low wages and income insecurity than non-minorities, more dependence on social assistance, subsidies, and benefits than non-minorities, more challenges finding affordable and adequate housing than non-minorities, more barriers to accessing health care and other essential services than non-minorities. These factors may make minorities more sensitive to changes in interest rates and inflation. They may have less room in their budgets to cope with higher costs of living. They may have less ability to adjust their spending or saving patterns. They may have less power to negotiate better wages or prices. They may have less access to information or advice on how to manage their finances. As a result, higher interest rates may worsen the economic inequality and social exclusion that minorities already face in Canada. They may reduce their purchasing power and living standards. They may increase their financial stress and hardship. They may affect their health and well-being. In conclusion, the Bank of Canada's interest rate hike affects the inflation rate and the cost of living for essential goods and services for all Canadians. But it may have a disproportionate impact on minorities, who may already face social barriers. This may widen the gap between them and the rest of society and undermine their economic and social rights. The Bank of Canada's interest rate hike affects the exchange rate and the competitiveness of Canadian exports, and how this impacts the employment opportunities and income growth of minorities who may already face labor market discrimination. The Bank of Canada, BC, has raised its key overnight benchmark rate to 4.75%, the highest level in 22 years, on increasing concerns that inflation could get stuck significantly above its 2% target amid persistently strong economic growth. This is the 8th increase since March 2022, when the BOC started its fastest tightening cycle in history. How does this affect the exchange rate and the competitiveness of Canadian exports? The exchange rate is the price of one currency in terms of another. It reflects the demand and supply of currencies in the foreign exchange market. A higher interest rate makes Canadian assets more attractive to investors who need to buy Canadian dollars to purchase them. This increases the demand for Canadian dollars and pushes up its value relative to other currencies. This is called an appreciation of the Canadian dollar. An appreciation of the Canadian dollar makes Canadian exports more expensive for foreign buyers and imports cheaper for Canadian consumers. This reduces the competitiveness of Canadian exports in the international market, especially when they compete with products from countries with lower interest rates and weaker currencies. For example, if the Canadian dollar rises against the US dollar, Canadian oil, minerals, cars, aircraft parts, and medicines will become more costly for US buyers. This could reduce the demand for Canadian exports and hurt the revenues and profits of Canadian exporters. How does this impact the employment opportunities and income growth of minorities who may already face labor market discrimination? The impact depends on which sectors and regions are most affected by the exchange rate movements and how they adjust to them. Some sectors and regions may benefit from a stronger dollar, while others may suffer. A stronger dollar may benefit sectors that rely heavily on imports, such as retail, manufacturing, and services. A stronger dollar lowers their input costs and allows them to offer lower prices or higher quality to consumers. This could increase their sales and profits and create more jobs and income for their workers. Some of these workers may belong to minority groups who may have more opportunities to find employment or advance their careers in these sectors. A stronger dollar may hurt sectors that depend largely on exports, such as resource extraction, agriculture, and tourism. A stronger dollar reduces their competitiveness and revenues in foreign markets and forces them to cut costs or innovate to survive. This could reduce their profits and employment and lower the income and well-being of their workers. Some of these workers may belong to minority groups who may already face labor market discrimination or barriers to entry in these sectors. They may have fewer options to find alternative jobs or upgrade their skills in a weaker export sector. The overall impact of a stronger dollar on minorities depends on how they are distributed across different sectors and regions, how flexible they are to move across them, and how responsive they are to changes in prices and wages. It also depends on how long the exchange rate appreciation lasts, how large it is, and how it interacts with other factors affecting the economy, such as productivity growth, trade policies, fiscal policies, and social policies. In summary, the Bank of Canada's interest rate hike affects the exchange rate and the competitiveness of Canadian exports, and how this impacts the employment opportunities and income growth of minorities who may already face labor market discrimination. A higher interest rate appreciates the Canadian dollar, which benefits some sectors and regions that rely on imports, but hurts others that depend on exports. The impact on minorities depends on their exposure to different sectors and regions, their mobility and adaptability across them, and other economic and social factors influencing their outcomes.